I did it. I purchased another net new dividend stock this morning. I now own 42 stocks in my dividend stock portfolio. I am really excited about this most recent purchase. I am going to share with you today the stock that I purchased, why I purchased it, and my entire fundamental dividend stock analysis. You can go to the description below. You can follow along at home. You can download the Excel spreadsheet that includes all of my analysis. But I will also be sharing charts on the screen like the one you see right here throughout the video today. And so you can follow along in the video as well. But I feel really strongly here on my channel that I just want to get the analysis out there. So you can just literally just download it from the description. There's no email sign up for this specific analysis. There's no affiliate link. I'm just getting my best work, my best content out there in the community. And so if you have not guessed by now, the stock that I purchased is PPL Corporation. It has a 5.6% starting dividend yield. This is a regulated electric utility. I am so excited to talk about this stock today. I have so much to say, so let's jump right into it. So I'm going to start with the high level, and then I'm going to get into the specific fundamental dividend stock analysis that I know all of you love to see because you want to understand how to analyze stocks at home and you want to see how I do it. So I'll get into that in a minute. But first, I have to talk about the high level. So this to me is a project stock. This is kind of a concept that I've alluded to on this channel before, but I want to talk about it a little bit more specifically today. I like to have project stocks. If you have not guessed by now, I have 42 positions. I like to have a project stock. What is a project stock to me? Well, my project stock of last year was General Mills. My project stock of earlier this year was AbbVie. My project stock right now is PPL Corporation. What this means is it's a new stock that I bought. I like to kind of build it up to size. I like to average in. It gives me something as an investor to focus on, something exciting, something new. And what it means is money that's coming through the door. I'm less likely to waste that money. I'm more likely to deploy the money in the stock market. The way I look at it is this. When I buy a new stock, like a project stock in particular, it's usually a smaller starting position, although I did try to build roughly half my position in PPL this morning, maybe a little less. Maybe we're more at like 40% of the position now. But I like to start with kind of a lump sum, but it's never at full size. And for me, I'm a perfectionist. I'm someone who cannot stand having all my stocks at the right allocations and then one that's like real small. And so for me, the one that's real small, I'll do everything that I have to bring it to size. And that means maybe taking on more odd jobs, consulting, just working harder, trying to generate more income, being more frugal, being more calculated with my expenses so that I can get more money into the project stock, which brings it to size. And so for better or worse, there's going to be a lot of people out there that argue with this concept. Ian, you're too diversified, this or that. I don't think I'm too diversified because my goal is to completely live off of dividends. So I need the diversification to shoulder risk, especially unforeseen risks, just weirdness out there, political stuff that I have no control over despite my best efforts at fundamental stock analysis. There's this weird political stuff that can happen. So because of that, I like to diversify. And so the concept of the project stock for me literally is by having that one stock, that kind of newer stock that's a little too small, it's a little under allocated, it gives me something to focus on and it triggers almost my subconscious mind to find ways to be more scrappy, more frugal, better with my money, better at saving money, but also generating money so that I can bring it to size and then the portfolio looks really clean. So that's project stock. That's my PPL right now. Also, I need more income right now. And so if you've been watching my videos for a while, you know I made some huge changes a few months ago. I'm taking a portion, a small sliver, but a portion of my dividend income now, and I'm using it to pay bills. I am doing that because as a family, quite frankly, we are at the point, I have a wife and 2 kids, and as a family, we're at the point where we could really use some of that income to pay for the expenses. It's expensive to raise a family in the greater San Francisco Bay Area. And at the same time, I've been working a long time. Our family has been working a long time to build this dividend portfolio, and it's kind of time to harness some of those dividends, to enjoy the dividends. That's the point of it after all. And so basically PPL kind of falls into that bucket that once I bring this to size, once it kind of leaves the project stock list, it's roughly 1% of the portfolio, maybe 0.8% to 1% in terms of the total portfolio. It gets there, I will stop reinvesting dividends. I'm going to pull dividends from it, and I'm going to use PPL to pay bills. And so the reason I gravitated towards PPL is it kind of falls into that bucket of stocks that I feel comfortable using right now to pay bills. And so that's really important to me. Conversely, there's a stock like Johnson & Johnson, my #1 favorite stock of all time. This stock, I don't want to use the dividends to pay bills now. I want to keep reinvesting that one. That one's going to pay bills later in life when I'm older. And so because I have different stocks in my portfolio where I'm reinvesting, some where I'm not, I'm kind of at the point where I wanted to find one more where I feel comfortable not reinvesting dividends because it brings in some of that current income that we can use to pay the bills. And so if you want to see, by the way, my entire dividend stock portfolio, you want to see which ones are reinvesting, which ones are not, I will include a link to that in the description below. For that one, you do need to enter your email address to receive the full dividend stock portfolio. So something else, I talked about this in my last video. I can link to it in the description below. There's a lot of risk out there right now. There's a lot of drama, if you will. I like the drama because it creates opportunity, but some of this drama is just politically charged, and I don't see it going away. I only see it getting bigger. And because of this drama, I just want to de-risk my portfolio through diversification. Regulated electric utilities tend to be a sector where it's a little bit more stable, carries a little bit less risk. Everyone needs electricity, hence the position in PPL. That being said, the sector that they are in is regulated electric utilities. Stuff can go wrong. Look what happened with Pacific Gas and Electric. Several horrible incidents over the last decade, unfortunately. Heart goes out to anyone affected by that bad stuff. It's just awful. But from an investor standpoint, it just goes to show that electric utilities actually do include a little more risk than some investors might have thought in the past. And so I like having PPL because it helps me diversify intra-sector. And if you've been following me, you know I already own Southern, Duke, and Hawaiian Electric. And so being able to diversify a little bit more intra-sector is something that is important to this investor. Now, I own 42 stocks now, and one other high-level update before I get into today's fundamental stock analysis. If you have not guessed by now, I've got merch. I finally have merch. And so if you guys have been waiting, a lot of you asking, how do I thank PPC Ian? What is a way that I can thank him for these videos? Look, I don't do the whole affiliate thing here like so many people do. I don't sell a course as of this time. I do have a book in the pipeline, but one way you can thank me right now, show your support for the community, show your support for the channel, is check out my store. I will link to it in the description below. I'm also going to do a little blog post on my website so that you can learn more about the merch, and I'm going to talk in the blog post about different sizes and stuff and how it fits so that if you are interested in buying a t-shirt, you can get the right size for you. But this is actually my favorite one, the Thug Life Investor shirt. I really love this one because it embodies this community. So if you want to get your hands on one of these, they are now available for sale. And so again, check that out in the description below. I'll link to the store, and I'll link to my blog as well, where I do a blog post that talks a little bit more about the t-shirts, the merchandise, how it fits, and all of that good stuff. But thank you in advance for those that want to support the community, want to support the channel through showing your true colors as a Thug Life investor. I have other shirts as well that don't say Thug Life for those that want something just more kind of just different things. I have some really cool designs there, so check them out. Leave your feedback. Let me know what you think about the designs, but thank you in advance. I love you guys. Everyone who supports the channel, it really helps. It means the world to me. And look, if you decide not to purchase a t-shirt, that is cool too. All of the support here, whether it's a simple like, whether it's a subscription, a comment, all that means the world to me. All right, guys, I love you all. Let's jump into the stock analysis. So PPL, today is August 29th of 2019. That's when I bought the stock. And so PPL, it's trading at $29.33 per share. The first thing I want to do is just a general analysis. I'm going to put it up on the screen of PPL versus Duke versus Southern, because these are kind of comparable companies. I'm going to actually do this type of analysis quite a bit through the video today. So you'll see me comparing these three a bit, because quite frankly, when I'm analyzing an electric utility, PPL does business in some states I'm not really familiar with. They're in Kentucky, Pennsylvania, and they're in the UK. Gosh, I love the fact that they're in the UK. We'll talk more about this later, but I don't know that much about them. I'm not a customer of PPL, so how do I get to know them? I compare them to known entities, which are Duke and Southern, stocks I've owned for years that I've done really, really well on. So the price per share for PPL that I purchased at today was $29.33. The forward estimate on earnings is 243. It puts the forward PE at a 12. This is actually, I'd say, a fair price for a regulated electric utility, if not slightly undervalued. PE of 12, anywhere between 12 and 15. That's, I'd say 10 and 15. That's kind of a good range, in my opinion, to buy a regulated electric utility. And so at a 12, that's kind of rare right now. I feel good about PPL, but it's there for a reason. We'll talk about that a little bit later. Duke, by contrast, has a forward PE right now of 18.61. So Duke is, I would say, perhaps a more premium company, but it is priced for that premium nature. And Southern, another premium company that I love, that I was talking about on this channel way back in the early days, is now trading at a forward PE of 19. And so PE of 18, 19, and 12. Right now I'm buying the value, I'm going for the 12. And so in terms of dividend yield, PPL is at a 5.62%, Duke is at a 4.09%, Southern is at a 4.29. So you get basically greater than 1 full percentage point greater dividend yield with PPL versus the other competitors, or they're not really competitors because it's regulated, but the other industry peers, if you will. And so just really quick analysis there to show you all about the comparison between the three. Basically on a PE ratio basis and on a dividend yield basis, PPL is looking sweeter. Now, what's really, really interesting is I started going through the annual report 2018. Again, I'm going to put some of this stuff up on the screen so you can see it, but you can also download it in the description below. This company, I love that it has exposure to the UK, and it has big exposure to the UK. And so I've talked about this so much. I'm a global investor, global citizen. Love this. Love the UK, by the way. Man, one of my favorite places on earth. I don't believe PPL serves London, which is one of my favorite cities on earth, but they're big in the UK. And UK is awesome. Shout out to everyone watching from the UK. I love you guys. And so what's interesting is in terms of revenue per share, they actually get the most revenue per share from Kentucky. But in terms of net income, these guys get a lot of net income. The most net income they're earning from the UK. They're getting basically just the lion's share of their net income from the UK. It looks like 1.1 billion in terms of net income from the UK. By contrast, Kentucky's doing 411 million, Pennsylvania 431 million in terms of net income. And in terms of electricity, they're delivering, it looks like twice as much electricity basically to the UK as compared to Kentucky and Pennsylvania. They're delivering 74,000 gigawatt hours of electricity to the UK. And so these guys are really, really big in the UK. Now, why is the stock down? It tapered off in 2018. They discussed this in their annual report. The reason it is down is because just like in the US, there's a lot of drama in the UK right now in the political environment with the whole Brexit thing going on. I know a lot of subscribers here have commented, Ian, you really ought to look at UK stocks because they're on sale now because Brexit has created some buying opportunities. And you know what? This isn't a pure play UK stock, but it is very heavily exposed to the UK. And it is a US stock, but it has trended way down because of uncertainty in the political environment. So there's kind of two things happening here. One, I love the exposure to the UK. Two, I love the fact that there's some uncertainty in the UK and it's creating a 12 PE on a forward basis, 2019, high starting yield. Awesome. So I love that stuff. And so moving on, I want to now talk just about some more numbers that I pulled from their annual report, some cool statistics. And so UK regulated, I guess they just show their earnings forecast for 2019. They basically expect UK to make up 58% of their earnings. So more than half of this company by earnings is UK centric. I love that. And so 23% Kentucky, 25% Pennsylvania. Then they're losing 6% in this category called corporate and other. And so I don't know fully what's going on there, but it all adds up to 100%. So next, what I started looking at was the analysis. In the annual report, they show 2014, 15, 16, 17, and 18. And so they compare those years in the annual report. And I just start looking at things when I compare 2018 versus 2014. So the 4 years have elapsed. What are some of the deltas on some of these metrics? And so revenue, for example, it's gone nowhere. When you compare 2014 versus 2018, revenue for PPL is down 1%. So this is, if you will, red flag number one. Company's not growing. Have to be honest with myself. I'm getting all excited about UK. I'm getting all excited about the dividend yield. But you know what? It's not all it's not all good stuff here. There's always going to be pros and cons with any stock. The first con that I came across is, wow, this thing is not growing. Next, operating margin or operating income. Operating income is only up 1% over the last 4 years, basically 2018 versus 2014. Now get this. This is something I want to point out. Operating margin, it's up a little, 2%. That doesn't matter. What more matters is the raw number. The operating margins at this company are unlike anything I've ever seen for a regulated utility. The operating margin is a 37%. And so 37% operating margin, and the net margin, by the way, is a 23%. And so we'll compare this versus Duke and Southern in a minute. But I'm just telling you, as an investor in regulated electric utilities, I've been investing in regulated electric utilities for a long time. One of my first positions was a company, Progress Energy, that was acquired by Duke. And so I've been at this a long time. I've never seen margins like this. And so I started digging more, and I'm like, why are these margins so good? The reason the margins are good is because of the UK. In the UK, like I was saying earlier, their revenue per share, it's not a very high revenue business, but it's a high profit business. They're earning a ton of profit in the UK. So for whatever reason, because of their exposure to the UK, that business has a high profit margin, and it brings the profit margins for the whole business up. I really like that. That being said, there is uncertainty in the UK about their business. As I read in the 2018 report, it's a less stable business, they're saying, than the US, a little bit more risky, less certainty in the political climate. And that's what's really funny. They're saying there's a lot of politics in the US now, and I would say there's a lot of uncertainty in many respects. But they're saying in their report there's even less certainty in the UK. So anyways, I hope that operating margin is safe and the UK business is safe, but that's the risk that I take getting into this thing. I understand the risk. I'm conscious about the risk. So net income over the last 5 years, this is more important than revenue. It is up, and so I'm happy to see that it's up by 5%. Actually, not even last 5 years. It's 4 years of elapsed time. The net margin, 23%. So they also talk about other things like their assets and debt. We're going to get more into that later, but in general, it looks like assets are trending down and long-term debt is trending up. And the dividend, by the way, is up 10% comparing 2018 versus 2014. So we'll get into a full assets liabilities analysis towards the end of this video. This is so important, though, to understand the assets are trending down, liabilities going up. This is a capital-heavy business. Regulated electric utilities, so capital intense. One of the risks, quite frankly, is interest rates, because these companies take on a lot of debt to produce these sophisticated systems that deliver electricity to everyone, and a lot of these systems need to be refurbished and improved over time, and they take on a lot of debt to do this. Usually they're able to make it work because they can pass price increases across to the customer, and they're regulated, so competition is not coming in, so they work with local governments, pass through price increases, and pay for their debt, basically. And so that's how it works. But we are at a historical low in terms of interest rates right now. I think they're going to stay pretty low for a long time, but that's a conscious risk with this entire sector, debt-heavy sector. Risk worth knowing is, look, the debt's big, the debt is there. It's kind of scary, so worth noting. So next, what I do is I just look at the dividends. The dividend per year right now is 1.648. In 2014, it was 1.492. And so, and the 1.648, by the way, is 2019. That's 2019 projecting forward based on their current quarterly dividends. So this comparison, 5 years has elapsed. The 5-year compound annual growth rate of the dividend is 2.01%. So basically, PPL is growing the dividend by 2.01% per year on average. Basically, this keeps up with inflation. So the way I look at this stock, I'm not getting rich, but a lot of people on the channel ask, Ian, if you were an older investor ready to retire, wanted to invest in dividend stocks right now, what would you pick? This is what I would pick, and the reason I would pick, and not only this, but other stocks like this, because I'm in those shoes. Yeah, I'm in my late 30s, but I'm basically looking at this right now. Within the next year, I'm going to flip off dividend reinvestment, and I'm going to pull cash flow from this. So in a sense, I am using this for my retirement, if you will, right now, probably as soon as 2020. And so this is the type of thing that I look at. Now, the dividend's not growing quickly, so it's going to keep up with inflation, but it's got a solid starting yield, and I can pull that cash flow now, pay bills. Generally speaking, a relatively safe business, and love the starting PE ratio, forward PE of 12, so I feel like I'm getting some value. Now, worth noting, if you go back in time, this stock has not really gone too well in terms of capital appreciation. So in the depths of the Great Recession, you kind of have to go back to the depths of the Great Recession to kind of get any kind of gain on this thing. And then if you didn't buy it during the depths of the Great Recession, you have to kind of go back even further, like to 2005. Just check out the stock chart on your own time, Yahoo Finance, check it out. You'll see in the long run, this thing is not a stock to buy for capital appreciation. But again, I have stocks that are doing fabulous on capital appreciation, just like J&J, for example, that I talked about earlier. I don't need cap appreciation on this. I need current yield because I'm using it to pay bills right now, or maybe not right now, but in 2020, it's going to pay family bills that we want to pay with dividends. And so that's great. Cash flows are pretty steady comparing 2018 versus 2016. They show those 3 years in the annual report. What it was nice to see, those cash at the end of the period is roughly doubled, or not quite doubled, but it's up. So comparing 2016 versus 2018, just cash sitting in their bank account is up. And so that's usually a good thing to see. All right, I want to keep moving. So I want to first talk about Duke and then Southern. I'm going to do a quick comparison of Duke, Southern, and PPL, and then I'm going to get into the balance sheet debt comparison as well. So revenue at Duke is up 9% comparing 2018 versus 2014. Again, mind you that revenue at PPL is down. It's down 1%. And so the key difference here is Duke is a growing company, PPL is not. Southern, by the way, revenue during that same period is up 27%. So you quickly see here, yeah, the thing's got a lower PE, but it's kind of got a lower PE for a reason, because it's not growing as quickly, or quite frankly, growing at all in terms of revenue. By the way, they're not growing the dividend as quickly either. I forgot to mention on the last segment, but when I did an analysis of Duke and Southern recently, I'll link in the description below. It's in my video if I were hypothetically starting over with 10,000 again. Their dividend growth rate was kind of, I think, in the mid-3s for both of those on a compound annual growth rate basis. So you're looking lower growth dividend here for PPL, which makes sense because the company is not growing the way Duke and Southern are. If you look at Duke, comparing 2018 versus 2014, net income is up 42%. And if you compare Southern 2018 versus 14, the net income is up 13%. So Duke, Southern growing, PPL not. That said, PPL has that golden exposure to the UK. I think it's golden, at least for my own diversification and for those huge margins. And let me show you something. The net margin at Duke is 11%. Net margin at Southern is 10%. So you compare 11 and 10%. My net margin at PPL is 23%. It's more than double the net margin at Duke and Southern. And so there's pros and cons with any stock. I have to be open. I have to be honest with myself. And so I'll tell you, when I look at Duke and Southern, in some respects, they're better because they're growing. Hence, they're both in my top 15 favorite stocks of all time. PPL will not. But in some respects, PPL is good for that sliver of my portfolio that I'm using right now to pay bills because it has the high starting yield and it has the low PE ratio. It gives me the UK exposure, which I love. And it gives me intra-sector diversification, which I think is thug life because this is a sector that actually does carry some risk. All right, so I want to move on here. The debt comparison. Whenever you're looking at utilities, regulated electric utilities, any kind of utility, quite frankly, debt is so critical. And I'll tell you, going into this analysis, I was biased. I thought, hey, PPL, they probably have the worst debt. They got to. Why is the PE so low? Why is the yield so high? Why is the stock down? Got to have bad debt situation. And so I was biased going in. But what the analysis showed me was not that. It actually showed me that the debt situation is pretty equivalent across the three, more or less. So PPL has a market cap. I want to introduce a metric here too. I like to look at debt as a function of market cap. I also like to look at debt as a function of assets. And I also like to look just at debt servicing. I didn't look at it this time, but this is a metric I kind of made up. I've commented on here on the channel before. Some people like it, some people don't, but I just want to bring it up again. Market cap, PPL is 21 billion, Duke 66 billion, Southern 61 billion. So I look at long-term debt, just long-term debt. Long-term debt, the ratio is worse off at PPL. PPL is a ratio of long-term debt to their market cap. They have basically 94% ratio because they have 20 billion in long-term debt. Duke, it's a 77% ratio, Southern 67. So long-term debt looks more favorable at Southern and Duke. However, there's more debt. I feel like these annual reports at these utilities, they kind of mask things a bit. So you have to be a sleuth. You have to kind of play the game and look at everything. And it's just not about long-term debt. There's other types of debt. They have short-term debt, and they also have what's called these deferred credits and non-concurrent liabilities. These deferred credits are, in essence, forms of debt, but they're just broken out on a separate line. And so when I add them all up, I add up all of PPL's debt, the short term, the long term, the deferred credits. I do the same for Duke and Southern. The ratios actually are different. PPL as a function of market cap is a 1.49. Duke is a 1.53. Southern is a 1.44. So Southern is the best. PPL comes in second place. Duke comes in last. And so that's the market cap way of looking at it. But heck, some of you like market cap analysis, some of you don't. I like it. I just find it an interesting way to look at it. But let's do the more traditional way. I'm going to look at assets as well. So assets at PPL are 43 billion, 145 billion at Duke, 117 at Southern. I actually trust their assets here because most of these assets are infrastructure. This is real assets. Everyone needs electricity. So I take it at face value that these are real assets. All right. Long-term debt as a function of assets at PPL is 40.46. It's 0.35 at Duke. It's 0.35 at Southern. So again, long-term debt is a little bit less favorable at PPL. But again, if I factor in short-term debt and also these deferred credits and non-concurrent liabilities, it gets a lot different. The ratio at PPL to assets is a 0.73, 0.70 at Duke, 0.75 at Southern. So basically here, Duke comes in first, PPL second, Southern last. And so they're all really close though. And so what this analysis showed me that I was so excited to see is I went into this thinking, oh my gosh, the debt is worse at PPL. And I originally thought that just because of the metrics, the fundamentals, but I also thought that because I just quickly look at long-term debt because that's what everyone calls out. But when I factored in the other forms of debt, short-term debt, non-concurrent liabilities, deferred credits, I get a different picture. And it actually looks, when I stack them up, that they're all kind of on equal playing field, more or less on the debt, in my opinion. Now, is that a good thing? Not really. They're all kind of in a bad position on debt, to be honest, but that's this industry. That is the industry we're in. And if Southern and Duke, kind of my logic sequence is if Southern and Duke are good enough to be in my top 15, and PPL is in a somewhat similar situation on the debt, hey, PPL's okay. It can come in that sliver of my portfolio that I'm using to kind of as a project stock, as I talked about in the beginning, and for current income that I'm going to start using in 2020. All right, everyone. So I hope you enjoyed the video today. If you want to show your support for the channel, check out the t-shirts. I'm so excited to finally offer these Thug Life t-shirts and other t-shirts as well. I'll link in the description below. I love you all, whether you decide to go for the merch or not. And I want to call out something else, as long as we're on the topic here at Thug Life. I own stock in Hasbro. Talked about this a little bit on Twitter and on my Facebook group as well, which I'll link to in the description below if you want to join. Man, one of my community members, I think it was Troy. I think that's Troy. Troy, shout out if you're watching. He commented this on a comment on YouTube. recently Hasbro made an investment. This is a company I own, small position, but it's gotten bigger. I love Hasbro. They made an acquisition of the company that owns Peppa Pig. Peppa Pig, huge kids franchise, love it. But what came along with it is the holding company that owns Peppa Pig also owns Death Row Records. And so this is literally, for me, a dream realized, a lifelong dream realized. I am serious. I'll tell you. I'll give you guys a story because we're at the end of the video. Those that don't have the time, please feel free to do your thing. I want to make good use of everyone's time here. That's why I have all the detailed timestamps in the description. But back in the day when I was in college, my buddy and I, as our senior project for computer science, we built a video game. It was called the Rap Game. It was a video game about the hip-hop industry. And so we went out, we tried to actually sell this video game. We actually got pretty far with one of the publicly traded companies. We didn't have luck selling it, but it was a great experience, a great opportunity to learn about business, still being in college, learn about business development, learning about sales, and obviously coding and building something from an engineering standpoint. But look, this is two guys who are engineers who have no sales experience trying to go out and actually sell something. Really good experience. And so basically what was funny though back in the day is we not only approached like the public video game companies, but we also went a little more scrappy. We sent this thing, I think we sent it to Snoop Dogg, and I believe we sent it to Suge Knight. And so I think this was actually, we were debating. I was the one that was, I was telling my friend, his name's Charles. I was like, Charles, you know what? We got to send this thing to Suge Knight. And I think he was a little more like, well, let's think it through. And we were both kind of debating and thinking, but then we're like, heck with it, let's do it. And so we never heard back from Suge Knight, but it's just a fun side story. But anyways, Death Row Records now is owned by Hasbro. Now, I don't know if Hasbro will spin it off or sell it. I sure hope they don't. It's a lifelong dream to have this opportunity to be a shareholder, a common stock shareholder in Hasbro, which owns now Death Row Records. So that is pretty thug life. That is pretty awesome. I'm so excited about that. Totally resonates with this channel as well, which is all about the thug life investing and making it fun, making it a little thug around here. All right, everyone. In terms of full disclosure, I am long the stocks mentioned today. I'm long Hasbro, ticker symbol HAS, PPL, ticker symbol PPL, bought it this morning. Duke Energy, ticker symbol DUK, Southern, ticker symbol SO. General Mills, ticker symbol GIS. AbbVie, ticker symbol ABBV. Johnson & Johnson, ticker symbol J&J. And Hawaiian Electric, ticker symbol HE. I own all those stocks that I mentioned in today's video. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed investment advisor first. Just sharing my journey here on YouTube for fun and entertainment. Just my journey, everyone. By the way, more disclaimers, disclosures in the description below as always. All right, everyone. I will see you in the next dividend investing video.